Right now, there are 8 artificial intelligence companies in the world spending over $10 million a year on a single software platform.
Yeah. And they are not spending this money on, acquiring more GPUs.
Right. They aren't spending it to hire better prompt engineers either, or to gather more training data.
No, not at all.
They are spending $10 million annually just to make sure their AI systems do not completely collapse under their own weight.
Which is just, it's wild to think about that scale.
No, it really is. So welcome to today's deep dive. We are unpacking a massive stack of financial data, specifically Datadog's Q2 2026 earnings call transcript.
Right. And
our mission here is to cut through all the Wall Street jargon. We want to understand what this single company's financial health tells us about the broader global shift into, AI, cloud adoption, and just corporate IT budgets in general.
Yeah, and the premise that observability, which is essentially just the act of watching a system operate, has become a $10 million line item for a single company. That fundamentally redefines how we think about IT budgets.
Yes, absolutely.
For anyone tuning in who doesn't spend their days reading through, enterprise SaaS documentation, Datadog is basically the central nervous system monitor for the cloud.
Right, the dashboards, the telemetry.
Exactly. They provide the telemetry and the security alerts that engineers use to basically make sure their applications stay online.
And their Q2 2026 earnings call is just a goldmine of data. An earnings call is essentially a company's financial polygraph test, right?
Oh, totally. That's a great way to put it.
Because you get the polished PR numbers in the prepared remarks, but then you get that unscripted Q&A with the analysts.
Right. And that's where you hear the actual anxieties. Hear about the emerging tailwinds and the friction points in the broader tech sector.
Exactly. So whether you are an investor trying to parse your portfolio, or maybe a tech professional tracking industry trends, or you're just insanely curious about how the world's biggest AI labs keep their systems from crashing.
Which, honestly, we all should be.
Right. This deep dive is going to give you the complete picture. So we have to start with the raw headline numbers because they basically set the baseline for everything else we are going to discuss today.
Yeah, let's get into the numbers.
So revenue for Q2 2026 came in at $1.12 billion.
Wow.
Yeah, $1.12 billion. That is a 36% year-over-year increase. And that actually beat the high end of their own internal guidance.
Which is no small feat in this macro environment.
Not at all. And when you look at quarter-over-quarter growth, they hit 11%. That's the steepest sequential growth they've posted since Q2 of 2022.
Right. So they basically added, $115 million in net new revenue in just a single 90-day period.
Yes. $115 million in 90 days. Just staggering. But the metric that really stands out alongside that top-line revenue is the free cash flow.
Oh, absolutely. The free cash flow is the real story there.
Because they generated $279 million in free cash flow, which translates to a 25% margin.
Right. And just to break that down for a second, free cash flow margin is essentially the percentage of total revenue that translates into actual liquid cash, after all the operating expenses and capital expenditures are paid.
Plain hard cash in the bank.
Exactly. And in the software industry, achieving 36% revenue growth while simultaneously maintaining a 25% free cash flow margin. That is incredibly difficult.
Because usually you have to pick one, right?
Right. Typically, companies trade growth for profitability. Like they burn cash to acquire market share. Managing to scale aggressively while throwing off that much cash indicates a highly efficient sales motion.
And a very sticky product.
Exactly. An incredibly sticky product.
And that stickiness becomes super obvious when you look at the customer landscape. So they grew their total customer base to about 33,400. That's up from 31,400 a year ago.
Okay. Steady growth there.
Yeah. But the engine of Datadog's business model relies entirely on what we could call the whales. They have 4,720 customers generating an annual recurring revenue, or ARR, of over $100,000.
See, the concentration is the key takeaway there. Those 4,720 customers represent roughly, 14% of the total customer base?
Give or take, yeah.
Yet they account for 91% of Datadog's total annual recurring revenue.
91%, that's insane.
It perfectly illustrates that fundamental enterprise software playbook, the land and expand strategy.
Right. You land the massive enterprise by solving one small, isolated problem.
Exactly. For a single engineering team, usually.
Right.
And once the platform is integrated, you introduce adjacent products, log management, application performance monitoring, security.
Until the platform is basically the bedrock of the company.
Right, until it's so deeply embedded in their daily operations that ripping it out becomes a logistical nightmare. It's just an impossibility.
Which brings us to the first major surprise from the transcript, and I found this fascinating.
Oh, the non-AI growth.
Yes. Given the absolute frenzy around artificial intelligence lately, the baseline assumption is that any tech company posting these kinds of huge numbers in 2026 is just riding an AI wave.
Right, you'd think it's all just AI hype driving the revenue.
Exactly. But Datadog's management specifically noted that their non-AI customer revenue accelerated to the high 20% year over year.
That's up from the mid-20s in Q1 and up from just 18% a year ago.
Yeah. It feels slightly counterintuitive, right? That the traditional legacy side of the business is the segment driving such aggressive, sustained acceleration.
It's actually the single most important macroeconomic signal in this entire transcript, in my opinion.
Really? More than the AI numbers.
Yeah, because for 5 consecutive quarters, traditional cloud migration and modernization have been accelerating. This isn't just flashy tech companies buying more software. This is broad-based demand across legacy industries. We're talking retail, banking, healthcare.
See, my initial thought reading that was to push back a little and question if this is just a temporary budget correction. Well, over the last few years, we saw a massive tightening of corporate belts, right? Interest rates went up, capital became expensive, and CIOs sort of paused their expensive IT modernization projects.
Right, the post-pandemic hangover.
Exactly. If a bank delayed moving their core systems to the cloud in, say, 2023 and 2024, it makes sense that they are finally writing those checks in 2026. Like, it's just a backlog clearing out rather than a sustainable long-term trend.
That's a really fair point. And actually, the analysts on the call probed that exact theory. But the response from CEO Olivier Pommel pointed to a structural reality rather than a cyclical catch-up.
Okay, what's the structural reality?
Basically, traditional enterprises are discovering that legacy on-premise infrastructure like physical servers sitting in a basement simply cannot handle the complexity of modern consumer expectations anymore.
Right, people want apps that load instantly.
Exactly. Think about a modern banking application. It relies on dozens of microservices. When you check your balance on your phone, the app isn't just pinging one single server in a basement.
It's pulling from everywhere.
Right. It is calling an authentication service, a transaction history database, a fraud detection algorithm, and probably a third-party credit score API, all simultaneously.
And if any one of those microservices fails, the user just sees a frozen screen. The entire app appears broken even if 99% of it is working.
Precisely. In a legacy, monolithic architecture, finding the error was relatively straightforward. But in a distributed cloud architecture with hundreds of microservices interacting in real time,
I imagine it's a nightmare.
it's like trying to find a specific drop of water in the ocean. Therefore, as traditional businesses are forced to migrate to the cloud just to stay relevant and competitive, purchasing a tool like Datadog transitions from a nice-to-have luxury to an absolute mission-critical requirement.
They literally cannot operate the new architecture without the diagnostic dashboard.
Exactly. They are flying blind without it.
Okay, that reframes the non-AI growth completely. The modernization of the global economy creates this permanent, expanding baseline of demand for observability.
Right.
But while that traditional modernization forms the foundation, the bleeding edge of the tech sector is where the numbers get truly staggering. Let's pivot to the AI native cohort and the hyperscaler ecosystem.
This is where the usage and the spending basically defy traditional software logic.
Yeah, so Datadog noted they now have over 750 AI native customers. But the power dynamic within that cohort is wildly skewed. Management stated that all 10 of the top 10 AI leaders in the world are currently using Datadog.
That is an absolute monopoly on visibility at the highest echelon of the tech sector.
All 10 of the top 10. And the spend reflects that dominance. Out of that cohort, 31 AI customers are spending over $1 million annually.
And 8 are spending over $10 million annually.
Right. We mentioned this in the intro, but we really need to unpack the mechanics here. Why does an AI company require $10 million worth of observability?
To understand the magnitude of that spend, we really have to break down the 2 distinct phases of artificial intelligence development: training and inference.
Okay, let's start with training.
So over the past few years, the industry's focus, and obviously the vast majority of the capital, has been dedicated to the training phase.
And training is basically the brute force phase, right?
Exactly. This is where an AI lab connects tens of thousands of highly advanced GPUs together in a massive cluster, feeds the system petabytes of raw data from the open internet, and forces the model to calculate the statistical probability of which word should follow the next.
And I imagine that process is incredibly fragile.
Oh, it's terrifyingly fragile. When you cluster 50,000 GPUs together, the mathematical probability of hardware failure approaches 100%.
Wait, really? 100%?
Yeah, I mean, across that many components, something is going to break. A single GPU might overheat, a network switch might drop packets, or a memory module might corrupt.
And what happens if one piece fails?
If one component fails during a synchronized training run, the entire cluster stalls. The AI lab is burning millions of dollars an hour in compute costs while the system just sits idle.
Just burning money because of one bad switch.
Exactly. So Datadog software monitors the thermal output, the network latency, and the kernel panics across the entire cluster, allowing engineers to isolate and bypass failing hardware instantly.
So during the training phase, Datadog is essentially acting as an incredibly sophisticated hardware babysitter, just ensuring this $100 million supercomputer doesn't trip over its own shoelaces.
That's a perfect analogy.
But during the Q&A, the management team highlighted a massive shift. The heavy lifting of training the foundational models is starting to plateau a bit, and the industry is rotating aggressively toward inference.
Yes. Inference is the execution phase. This is when the trained model is finally deployed into the real world and actually responds to user prompts.
And the CEO stated as a rule of thumb, anytime you train a model, you will eventually want to infer exponentially more than you trained.
Right, because training happens once, or in cycles. But inference happens millions of times a day across a user base.
So we need to explore why inference fundamentally changes the observability requirements. Because on the surface, it seems like inference would be way simpler to monitor than training.
It seems like it, right?
Yeah. If I type a prompt into an AI, the system just generates a text response. Why does that require a deeper level of monitoring than a 50,000 GPU cluster?
Well, the complexity of inference isn't in the hardware, it is in the software pipeline. Specifically with the rise of retrieval augmented generation, or RAG.
Right, RAG.
And autonomous AI agents. When a user queries a modern AI system, the model rarely answers purely from its static training data anymore. The prompt actually triggers a cascade of microactions.
Okay, let's trace that cascade for the listener. Say I ask an AI customer service agent to summarize my recent billing history. What actually happens under the hood?
Okay, the moment you submit that prompt, the application first queries a vector database.
And a vector database is what exactly?
It's a specialized storage system that doesn't hold traditional rows and columns, but rather mathematical representations of data. This allows the AI to search for concepts rather than exact keyword matches.
Got it. So it's looking for the concept of my bills.
Right. The application retrieves your billing documents from the vector database, appends those documents to your original prompt, and sends that massive package of context over to the large language model.
The LLM.
Yes. The LLM processes the context, generates the response, and sends it back to the application, which then formats it and displays it to you.
And I'm guessing every single step in that sequence is a potential failure point that could cost the company money or just degrade the user experience.
Exactly. The company running the AI needs to track the latency of the vector database search. They need to measure the exact number of tokens sent to the LLM because they are billed per token.
Ah, right, the token billing.
They also need to monitor the LLM's response time, and most importantly, they need to track whether the AI agent hallucinates or violates its programmed guardrails.
So you are no longer just monitoring server uptime, you are monitoring the cognitive logic and economic efficiency of an autonomous system in real time.
Yes, across millions of distinct user interactions.
That is wild. So the transition from training to inference represents a massive expansion of Datadog's total addressable market.
Oh, huge.
They aren't just monitoring the physical cluster anymore, they are monitoring every individual thought process of the AI. Now, to capture that level of detailed telemetry, Datadog clearly realized that their traditional toolset needed a massive overhaul.
Which brings us to Dash.
Exactly. Their June user conference, Dash, where they unveiled over 100 new products and features.
100. The pace of innovation is staggering.
It really is, but it's the expansion of their Bits.ai product line that really signals where this company and the broader industry is heading.
Bits.ai represents the inflection point where observability transitions from a passive reporting tool into an active, autonomous participant in the engineering process.
Meaning what exactly?
Basically, Datadog is taking the vast ocean of telemetry data they collect and feeding it into their own AI models to automate the core workflows of human engineers.
Okay, the transcript breaks this down into two specific loops. First is the DevOps loop, which traditionally involves detection, investigation, and remediation.
Right. So in a normal traditional scenario, an application crashes. An automated alert pages an engineer at 3:00 a.m.
The classic nightmare scenario.
Right. The engineer logs into Datadog, spends an hour cross-referencing logs and network graphs to find the root cause, and then manually writes a patch to fix it.
A process that is entirely dependent on human reaction time and human pattern recognition.
Yes. But with the new Bits.ai capabilities, the AI detects the anomaly, instantly correlates it against the entire infrastructure topology to identify the root cause, and then actively recommends and implements the fix based on predefined guardrails.
The system repairs itself.
Exactly. It repairs itself.
That's the DevOps loop. Then you have the development loop, which is the actual writing of the software. Datadog announced Bits Release, which acts as an AI validation agent for code changes.
They also announced Bits.code, which reads the code base and generates pull requests to fix bugs on its own.
And Bits.testing, which autonomously writes synthetic tests to ensure the application holds up under simulated traffic.
They are essentially providing specialized AI copilots for every distinct phase of the software lifecycle, from the moment a developer types a line of code to the moment that code is executed by a customer.
The technical achievement is incredibly impressive, but an analyst on the call brought up a fascinating paradox regarding this automation, and I think we need to explore the economic implications of it.
The usage paradox. Yeah, this is a great point.
Because Datadog's traditional billing model is fundamentally based on volume, right?
Correct. The more logs a customer ingests, the more errors a system throws, the more time engineers spend querying databases during an outage, the higher the Datadog bill at the end of the month.
So if Bits.ai becomes so incredibly efficient that it catches memory leaks during the coding phase, or it instantly auto-remediates a server failure before it cascades into a full system outage, doesn't that inherently reduce the volume of diagnostic data generated?
That's the question.
Right. If the AI eliminates the crisis, aren't they innovating themselves out of billable usage?
It is the textbook innovator's dilemma applied to usage-based pricing. I mean, if you charge for the medicine, curing the disease destroys your revenue stream.
Exactly. So how do they justify this?
Well, CEO Olivier Pommel's response to this analyst was really a masterclass in modern SaaS economics. His core argument was that providing higher order value ultimately drives deeper architectural reliance.
The theory being that if you make the system more efficient, the customer will use it more.
Right.
But how does that manifest mechanically? Like, how does fixing a problem faster lead to a higher bill for the customer?
It shifts the value proposition from diagnostic triage to foundational infrastructure management. Think about it. If Bits.ai can definitively prove that it saves a company millions of dollars in downtime and reduces the need to hire entire floors of Tier 1 support engineers,
The CTO is going to be thrilled.
Exactly. The Chief Technology Officer doesn't shrink their Datadog footprint in response. Instead, they mandate that every single application, every new microservice, and every internal tool must be built on the Datadog platform.
Ah, I see. So the usage volume increases not because of errors, but because the scope of adoption just widens massively.
Right. When Bits.ai removes the manual friction of troubleshooting, engineers naturally build more dashboards, they track more granular metrics, and they even pull non-engineering staff like product managers and business analysts into the platform.
So you trade the spiky revenue of an unpredictable crisis for the sustainable, expanding revenue of total platform dependency.
That is exactly the play.
Now, to enable that total dependency, especially in an AI-driven environment, Datadog had to solve a deeply technical, almost invisible friction point that engineers have been battling for years.
You're talking about infinite cardinality.
Yes. The announcement was labeled infinite cardinality, and it requires a thorough explanation because it basically dictates how software will be built going forward.
It's a game changer. So, cardinality is the mathematical concept of uniqueness within a data set. To understand why it matters in observability, we really have to look at how telemetry data is actually structured.
Okay, break it down for us.
When an application sends a data point to Datadog for example, measuring the response time of a web page, the engineer attaches tags to that data point so they can filter and search it later.
Right. A tag would be something like the geographic region. So you have a tag for region North America and maybe region Europe.
Correct. That is an example of low cardinality. There are only a handful of possible geographic regions. If you add a tag for the operating system, Windows, Mac, Linux, you multiply the combinations.
So 10 regions times 3 operating systems equals 30 unique time series data streams.
Exactly. And relational databases and traditional indexing engines can handle low cardinality without breaking a sweat. 30 streams is nothing.
But high cardinality is when you introduce tags that have millions of unique values.
Precisely. The absolute nightmare scenario for a traditional time series database is when an engineer decides to tag a metric with the user ID or a session ID.
Oh boy.
If an application has 50 million active users, tagging the response time metric with the user ID instantly creates 50 million unique time series streams.
The mathematical multiplication of high cardinality data completely overwhelms the indexing architecture.
It shatters it. Historically, when a database tries to maintain an index of 50 million unique, constantly updating tags in active memory, the compute costs skyrocket. The search queries time out and the system literally crashes.
So because it is so computationally expensive to process, observability platforms have traditionally penalized customers for high cardinality data, right?
Right. They either implement hard limits on how many unique tags you can create, or they charge astronomical overage fees.
Which creates a perverse incentive.
Yeah.
The engineering team actually has to avoid collecting the most granular, useful data because the finance department is yelling at them about the ballooning monitoring bill.
Exactly. The engineer is flying blind on a micro level just to save money on the macro level. So when Datadog announces infinite cardinality, they are claiming they have fundamentally re-engineered their back-end architecture.
To completely decouple data storage from compute indexing.
Yes. By utilizing proprietary columnar database structures and highly optimized query engines, they can ingest, store, and instantly search data sets with essentially limitless unique combinations without passing a massive compute tax onto the customer.
And this capability is being rolled out specifically because artificial intelligence forces cardinality to go exponential.
The AI infrastructure demands it. I mean, if you have a cluster of autonomous AI coding agents, you don't just have 10 regions and 3 operating systems anymore.
Right.
You have thousands of agents, each running a specific version of a language model, executing highly unique dynamic prompt chains, interacting with specific subdirectories of a code base. The pathways are entirely non-deterministic.
So if an engineer cannot tag every single microaction with a unique identifier, they have no way to audit what the AI is actually doing.
Exactly. By solving the mathematical friction of infinite cardinality, Datadog is removing the structural ceiling on how complex an AI application a developer can actually build.
They removed the database bottleneck just as the volume of AI telemetry is preparing to explode. That's incredibly well timed.
It's a massive competitive moat.
But as these autonomous agents scale up and developers rely on Bits.ai to write and deploy code faster, it introduces a terrifying secondary consequence.
The security risks.
Exactly. A machine acting autonomously without human oversight is a profound security vulnerability, which transitions us to the rollout of their Guardian model and the complete re-architecture of the AI security stack.
The cybersecurity landscape has shifted so violently in the last few years that legacy security postures are effectively obsolete at this point.
Let's talk about the traditional security model first. It relies heavily on signature-based detection, right?
Yes. So when a piece of malware is discovered by researchers, its underlying code is analyzed, and a unique cryptographic hash of signature is generated and added to a global blacklist.
And then a firewall simply checks incoming traffic against the list of known bad signatures. If it finds a match, it blocks it.
Right. But signature-based detection is useless against modern AI-generated attacks, specifically polymorphic malware.
Polymorphic malware, meaning it changes its shape.
Exactly. An AI can now write a piece of malicious code, execute an attack, and immediately rewrite the code's syntax, changing its signature entirely before it replicates and attacks the next server.
So the function remains malicious, but the appearance constantly mutates.
Yep. The blacklist is useless because the signature has never been seen before. Furthermore, human reaction time is no longer a viable defense mechanism.
Because the AI attacks happen in milliseconds.
Right. If an AI agent discovers an open vulnerability in a vector database, it doesn't wait for a human hacker to manually execute an exploit. The agent extracts the data, alters the access logs to cover its tracks, and shuts down the connection in a fraction of a second.
So a human security analyst receiving an alert 3 minutes later is conducting an autopsy, not a defense.
That's exactly what it is, an autopsy.
That terrifying reality explains the architecture of the AI Guard Suite Datadog just introduced. They are moving away from reactive observation and integrating directly into the runtime environment.
Yes.
The first component is AI Guard Agent Discovery, which automatically scans a customer's entire network architecture to find and map every single custom AI agent currently operating.
Whether it was officially deployed by the IT department or secretly spun up by a developer trying to cut corners, because visibility is the prerequisite for security.
Right. You cannot defend against a shadow AI agent if the central command center doesn't know it exists.
Exactly.
So once mapped, they deploy AI Guard for custom agents, which provides active runtime protection. It isn't looking for static signatures, it is analyzing behavioral intent.
Right. So if an AI agent that normally just queries a product database suddenly attempts to open a network connection to an unknown external server, the runtime protection intercepts the execution command in real time.
And kills the process before the connection is even made.
Before the data can leave the building. And specifically for the development pipeline, they announced AI Guard for coding agents.
How does that work?
If a developer is using an AI copilot to write an application, the Datadog security layer audits the AI's output, instantly blocking it from integrating known malicious packages or vulnerable dependencies into the codebase.
So they are shifting security as far left in the development pipeline as physically possible, catching the vulnerability before the code is even committed, while simultaneously pushing active defense as close to the hardware execution layer as possible.
It's a full spectrum defense.
Now, the underlying strategy here is fascinating, especially when you look at the Q&A exchange regarding the Security Operations Center, or the SOC.
SOC strategy is brilliant.
So Datadog has historically pushed customers to use their proprietary SIEM product. Let's define SIEM for the listener.
A SAM Security Information Event Management System is the central aggregator. It pulls all the logs from firewalls, antivirus software, and identity management tools into one massive database, applies correlation rules, and alerts the security team to complex attacks.
Right. And ripping out a legacy SIEM and replacing it with a new one is widely considered one of the most painful, politically fraught, and operationally dangerous migrations a chief information security officer can undertake.
The switching costs are astronomically high. Nobody wants to migrate their SIEM.
Which is why the CEO's announcement during the call was so strategic. Datadog separated their proprietary AI security agent, the Bits security analyst, from their proprietary SIEM database.
Yeah, this was huge.
They are actively allowing their customers to deploy the Datadog AI analyst to analyze data sitting in a competitor's SIEM platform. On the surface, this looks like they are cannibalizing their own data storage revenue.
Right, why give up the storage?
But it is an incredibly calculated Trojan horse wedge strategy.
It is brilliant enterprise sales maneuvering. Datadog recognizes that their AI security analyst, because it understands the context of the underlying infrastructure so deeply, can identify threats vastly more accurately than the legacy correlation engines built into traditional SIEMs.
So if they force a massive Fortune 500 company to migrate their entire data lake to Datadog just to use the AI analyst, the customer will refuse. The friction is too high.
Exactly. But by allowing the Datadog AI agent to plug into the existing legacy system, the customer immediately experiences the superior diagnostic capability without the pain of migration.
And the Datadog AI becomes the primary interface the security team uses every single day.
Yes. And once the human analysts rely entirely on the Datadog AI interface, the legacy SIEM database basically just becomes dumb, expensive storage.
Wow.
Over time, the gravitational pull to consolidate the data into Datadog's natively optimized environment becomes overwhelming. They infiltrate the SOC through the AI interface, prove their value, and eventually consume the entire infrastructure budget.
That is ruthless and brilliant. Which transitions us perfectly into the actual monetization of these strategies. We have covered the macro shift toward cloud computing, the technical requirements of AI inference, the rollout of Bits.ai, and the Trojan horse security model.
Right.
But we need to look at the massive enterprise contracts management highlighted to see how these theories actually translate into revenue.
Because the earnings call provides a specific anatomy of how these mega deals are constructed, and it all revolves around the brutal economics of consolidation.
Let's run through them. The first deal they highlighted was a multi-year contract with an unnamed media giant, featuring a total contract value of over $30 million.
$30 million.
Yeah. And the critical detail is that Datadog completely displaced 4 different commercial and internal tools, standardizing the entire company on one platform. But the technical catalyst for the win is the most interesting part. They won because of their capability to handle BYOC, bring your own cloud logging at a petabyte scale.
Yeah, BYOC fundamentally alters the traditional software as a service architecture. Well, in a standard SaaS deployment, the customer transmits all of their raw telemetry data over the public internet to Datadog's centralized servers for analysis and storage.
Which works perfectly fine if you are sending gigabytes of data.
But a petabyte is 1,000,000 gigabytes.
Yeah.
It is a scale of data generation that is difficult to even conceptualize. When a media giant attempts to send petabytes of streaming logs, CDN metrics, and user behavior data out of their own Amazon Web Services or Google Cloud environment, they are hit with massive network egress fees.
Ah, the egress fees.
Right. The major cloud providers charge almost nothing to put data into their servers, but they extract a massive financial penalty when you try to transfer it out. Moving petabytes of data simply to run observability queries destroys the media giant's profit margins.
So how does Datadog solve that?
Datadog bypasses the egress fee entirely by reversing the architecture. Instead of moving the mountain of data to the analysis engine, BYOC sends the Datadog analysis engine to the data.
Oh, that makes so much sense.
The raw logs remain secured in the media giant's own AWS storage buckets, completely within their own virtual private cloud. Datadog's query interface executes the search locally within the customer's environment, only extracting the tiny final result set.
So they won a $30 million deal because they possess the technical flexibility to eliminate the customer's cloud provider tax.
Exactly.
And we see that same theme of operational consolidation across the other mega deals. They highlighted a South American bank that signed a 7-figure deal adopting 11 different products.
Right.
The bank's primary motivation was gaining singular visibility from their legacy on-premise mainframe systems, the ancient code that actually processes the money, all the way out to their modern cloud-native microservices hosting their mobile app.
Because that unified visibility dramatically reduced their mean time to resolution for live outages.
Which is critical for a bank.
When a bank's payment gateway goes down, the financial loss is calculated per second. The cost of an 11-product Datadog contract is a fraction of the cost of a sustained multi-hour outage caused by engineers trying to cross-reference logs between disjointed systems.
Then you looked at the Fortune 100 health insurer. They expanded their existing contract to utilize 19 different Datadog products. The driving factor wasn't just technical performance, it was regulatory survival.
HIPAA compliance.
Yes. The Datadog secured the expansion because of their ironclad HIPAA compliance and their ability to safely obfuscate personally identifiable information before it is ingested into the log management and real user monitoring systems.
In heavily regulated industries like healthcare or finance, security and compliance are impenetrable competitive moats. A scrappy startup might build a faster dashboard, but a Fortune 100 insurer cannot legally route patient medical records through software that hasn't undergone years of grueling compliance auditing.
So Datadog uses their massive scale to amortize the cost of regulatory compliance, basically locking out smaller competitors.
Exactly. It's a massive advantage.
So looking at these deals, $30 million from a media giant, massive expansions in banking and healthcare, it brings into focus a specific tension discussed during the Q&A between engineering departments and chief financial officers.
Yeah, the CFO versus engineer dynamic.
Because an analyst pointed out that while developers love Datadog's rapid product velocity, CFOs are notoriously antagonistic toward the massive monthly bills.
The CEO's response addressed the core reality of enterprise software sales in 2026. Software must either demonstrably increase revenue or mathematically decrease operational costs.
Right.
When Datadog's sales team pitches a multi-million-dollar consolidation, the primary audience is the CFO. The argument relies on proving that paying Datadog a massive premium is ultimately cheaper than the status quo.
Because the status quo is currently paying for 4 disparate observability tools. They're paying the AWS egress fees to route data between them.
And they're paying the salary of an internal engineering team whose sole job is to maintain the brittle integrations connecting those 4 tools.
And suffering the financial penalty of prolonged downtime when those integrations fail.
Exactly. Datadog must prove that the total cost of ownership of their unified platform is lower than the sum of that chaos.
And considering their 120% net revenue retention rate, meaning existing customers are spending 20% more this year than they did last year, the CFOs are clearly accepting the math.
They absolutely are.
However, enterprise software math does not always plot a smooth upward trajectory. Despite the massive macro tailwinds and the product innovations, there was a specific, highly conservative caveat in management's financial guidance that really rattled the analysts.
Yeah, we have to talk about this.
We have to address the elephant in the room, the mystery of the largest customer.
This is the portion of the transcript where the nuances of SaaS pricing models create significant anxiety for investors.
Let's outline the financial forecast first. The CFO, David Obstler, provided guidance for Q3 2026, projecting revenue between $1.35 billion and $1.45 billion.
Solid numbers.
For the full fiscal year, they expect total revenue of $4.45 to $4.47 billion. That represents 30% year-over-year growth while maintaining an operating income margin of roughly 23%.
By any standard metric, projecting 30% growth at a $4.5 billion scale is exceptional.
The CFO explicitly paused to provide context that de-risked that guidance. He revealed that Datadog recently signed a massive 9-figure renewal with a leading AI company who is currently their absolute largest customer.
Okay.
However, he noted that starting in Q3, Datadog has seen a noticeable usage reduction from this specific client. Management chose to fully absorb the impact of this reduction into their conservative guidance model.
Right.
Now, if I am an investor reading this transcript, that disclosure sounds like a blaring klaxon. If the most sophisticated, heavily funded AI laboratory on the planet, a company with access to unlimited capital, is actively optimizing their infrastructure to drastically reduce their Datadog bill, it implies they figured out how to operate without relying so heavily on the platform.
It's a scary thought.
It suggests the land and expand model has a ceiling, and eventually every other customer will learn those same optimization tricks. Is this a canary in the coal mine?
It is the most critical vulnerability raised on the call, for sure. But to understand whether it represents a structural flaw or just a mechanical reality of cloud infrastructure, we have to unpack the commit versus usage pricing model.
Okay, let's break that down.
When an AI hyperscaler negotiates a $100 million contract with Datadog, they do not pay for unlimited flat rate access. They establish a commit. The customer commits to a baseline minimum spend over the course of a year, and in exchange, Datadog grants them steep volume discounts on the per unit cost of data ingested or servers monitored.
Okay, a helpful way to conceptualize this is the structure of an old prepaid mobile data plan, right?
Oh, that's a perfect analogy.
You commit to paying a base rate for, say, 10 gigabytes of data every month. If you stay under 10 gigabytes, you pay the flat rate. But if you tether your laptop and stream 4K video all weekend, you blow past your commit and incur massive variable overage fees based on your actual usage.
That analogy maps perfectly to the AI infrastructure lifecycle. When this massive AI customer decides to train their next generation foundational model, they activate a cluster of 100,000 GPUs.
And for 4 consecutive months, the compute engine runs at maximum capacity.
Right. The volume of diagnostic telemetry generated by that cluster blasts through their baseline commit, resulting in Datadog invoicing them for massive, highly profitable overage fees.
But once the training run is completed, the massive cluster is spun down. The AI lab shifts into an evaluation and alignment phase, running tests on a fraction of the hardware.
And suddenly the telemetry volume plummets, and the customer drops back down to their baseline commit level. Exactly. The usage reduction the CFO is referencing isn't necessarily a sign that the customer found a cheaper competitor or fundamentally altered their architecture to avoid Datadog. It is highly likely just the natural cyclical fluctuation of AI development. They basically turned the massive machine off for a quarter to review the results.
That makes total sense. So the strategic takeaway from the management team was how they framed this volatility. The CEOs pointed out that if you surgically remove this one massive volatile customer from their financial models, the core trajectory of the remaining 33,000 customers is still accelerating robustly.
They are essentially isolating the variable. By de-risking the guidance, they are telling the market, even if this 9-figure whale stays dormant for the rest of the year, our baseline business will still comfortably generate 30% growth.
It is a flex of confidence. acknowledging the risk of customer concentration while demonstrating the resilience of the broader platform.
Exactly.
And they are not resting on that baseline business either. The final piece of the transcript we need to dissect is the forward-looking internal research and development. Datadog isn't just monitoring other people's AI systems. They are aggressively building their own foundational models, specifically aimed at a very unique type of data.
Yes. The CEO highlighted the launch of TOTO V2, which is a state-of-the-art time series model. And we really need to distinguish this from the AI models the general public interacts with.
Because a system like ChatGPT is a large language model. It is trained on static, unstructured human textbooks, articles, websites. It understands grammar, syntax, and conceptual logic.
But the data Datadog collects isn't human language.
Right, it is telemetry.
It is time series data. Time series data is a continuous chronological flow of quantitative measurements. It is the CPU temperature at 1.000 p.m., 1.01 p.m., and 1.02 p.m. It is the network latency measured every millisecond for a week.
And Datadog possesses the largest proprietary repository of real-world enterprise time series data on the planet.
By far, they are taking that massive data set and training TOTO V2, a foundational model specifically designed to understand the mathematical patterns, cyclical rhythms, and anomaly structures of machine infrastructure.
They also noted the recent acquisition of a company called Adaptive ML to accelerate this exact research. The implication here is profound. If you train a highly advanced model on the operating patterns of the entire global cloud infrastructure, it doesn't just learn to identify when a server crashes.
No, it learns the microscopic, cascading symptoms that occur 3 hours before a server crashes.
Which brings the entire Datadog strategy full circle. They are transitioning from providing a passive diagnostic dashboard that requires a human engineer to interpret the data to providing an autonomous intelligence engine that predicts and mitigates failure before it manifests.
It's an incredible evolution.
We have covered an immense amount of technical and financial ground unpacking this Q2 2026 earnings transcript. We started with the macro revelation that non-AI cloud migration remains a massive, accelerating structural force.
Right, the traditional modernization.
We deconstructed the infrastructure requirements of the AI native cohort, tracing the evolution from brute force model training to the highly complex multi-agent observability requirements of inference.
The shift to R and vector databases.
Exactly. We explored the product velocity of the Dash conference, detailing how Bits.ai automates the engineering loops and how solving the mathematical friction of infinite cardinality clears the runway for complex AI deployments. We looked at the Guardian model, unpacking the shift to active runtime protection and the Trojan horse strategy to dominate the security operations center.
A brilliant sales strategy.
We validated the economics through mega deal consolidation. And finally, we parsed the cyclical reality of commit versus usage pricing with the world's largest AI labs.
It really demonstrates how deeply intertwined software economics and physical infrastructure have become. You simply cannot understand the trajectory of the global economy without understanding the telemetry that keeps it running.
Well said. But before we sign off, I want to leave you with a final thought to ponder a provocation that builds on the technological trajectory we've discussed today.
The rapid evolution of Bits.ai and the deployment of autonomous coding and security agents points toward a fundamental restructuring of the software industry. We are rapidly approaching a reality of true machine-to-machine SaaS.
Machine-to-machine SaaS.
Yeah. Think about it. If an AI coding agent writes the software, an AI testing agent validates it, an AI security agent monitors it in runtime, and Datadog's Bits.ai autonomously identifies flaws and deploys the patches, the human engineer is entirely removed from the operational loop.
Wow.
So the question to consider is this: what happens to enterprise software sales, marketing, and pricing when the primary buyer, the primary user, and the primary beneficiary of the platform is no longer a human being, but another autonomous algorithm?
That is wild.
How do you pitch a multi-million-dollar consolidation deal when the entity negotiating the contract is the infrastructure itself?
When the machines are the ones auditing the efficiency and deciding which software to provision, the entire economic model of the tech sector has to be rewritten. That is fascinating. Thank you for joining us on this deep dive into Datadog's Q2 2026 financials. We highly encourage you to look at the architectural diagrams, the security protocols, and the software invoices within your own organizations.
Because these macro trends are not abstract theories.
No, they are currently reshaping the foundation of your daily operations. Because as we've seen today, the financial transcript reveals the undeniable truth of the industry as long as you know how to read the telemetry. We will see you next time.